Watch out! Real estate tax changes coming. In this episode, I'm going to address Biden, major real estate tax hikes. You're going to be shocked with what President Biden has up his sleeve in his proposals to get tax revenue. So, my name's Doug Andrew, and I've been a financial strategist and a retirement planning specialist for more than 4.5 decades. And so I've helped thousands of people optimize their financial assets and minimize taxes. Well, a lot of clients that I've worked with are major real estate investors. Now, I don't consider myself a major real estate investor, even though I probably own more real estate than most people do. But this is what the problem is. When you own real estate, historically, there have been a lot of tax incentives to be able to save taxes by depreciating properties and having long-term capital gains where you can keep deferring. It looks like a lot of those advantages are going to be going out the window with what President Biden is proposing. So if you are a real estate investor or you know somebody who is, I would recommend you share this video, comment, click like, subscribe to this channel because I answer in-depth questions like this almost on a daily basis and post them on this channel. It's free, three-dimensional wealth. So let's go to the advantages heretofore of owning real estate and what President Biden has up his sleeve, because he needs to raise a lot of tax revenue to fund all of these initiatives where he is spending trillions of dollars that the government doesn't have. And so Janet Yellen, the Secretary of the Treasury, said, you've got to start showing me where you're going to tax people and get the money back for what you're spending out there with infrastructure and relief and so forth. And it looks like most of those bills aren't even for those purposes. Let's not go there right now. Let's talk about when you own a piece of real estate, let's say a rental property, and you want to depreciate it down, let's say over 27, 28 years. And that's one of the tax advantages, because when you own a rental property, for example, you depreciate down the building, you take the interest if you have debt on it, and you have maintenance and repairs, and those three big expenses you get to write off, and you offset that against the rent, and usually you'll end up with a loss that you can then carry forward to your personal tax return, so it's a tax shelter. But what's happening is that real estate is appreciating over time. I have seen many people in California, on the East Coast, all over the country, where they bought, let's say, a rental home for $250,000 30 years ago. And that has appreciated, let's say, an average of about 5% a year, which is very typical. So if you take a 5% appreciation rate, you divide that into the number 72, and the real estate will double in value in 14.4 years. Let's just say 15 years. So that rental home that you bought for $250,000 is worth $500,000 15 years later. Well, it doubles again in another 15 years. So 30 years down the road, it's gone from $500,000 doubled to $1 million. This is very common. I know people in the San Francisco Bay Area who bought a home for $250,000 40 years ago, and it's worth $4.8 million right now. So this is realistic. So here's the problem. You buy that, you depreciate it down, and so the basis is now next to nothing, except for the value of the land. Now it's worth $1 million. Now, whenever you sell that, that's called a capital gain. Now, a capital gain is largely, just inflation. And I've always felt it was unfair to tax people for inflation, the cost of living going. So usually, if you have a Republican Congress, they will generally say, you know what, give them a break. let's just charge the maximum of 20%. So under Donald Trump's administration, the maximum you would pay on a capital gain tax is 20%. That's very common. Those who believe in lower taxes, okay? Tax revenuers, though, who like to have a lot of initiatives, they like to raise the capital gain tax back up to the ordinary income tax rate. This is what Biden wants to do. He wants to raise it from 20% up to 39.6. That's nearly double. So he's going to raise the tax. That's double the tax. And he wants to do away with the step up in basis on long-term capital gains. What? This has been there forever, meaning a lot of people who have highly appreciated properties or assets, they hang on to it, or if they buy a like property, they do 1031 exchanges until they keep postponing and postponing until they die. Why do they do that? To avoid paying the capital gain, because if you inherit that from your parents and it's worth $1 million, you don't have to pay a capital gain tax. You get a step up in basis. You only have to pay a capital gain tax on what you sell it for over and above what it was worth when you inherited it. So let me tell you what that means. In that example, that means if you inherited that property and you sold it a year later for $1,100,000, you would only have to pay 20% to the federal government in a capital gain tax on $100,000 because it only appreciated $100,000 over and above what it was worth when you inherited it. Biden wants to do away with the step up in basis. So that means if you inherited that under his proposal, you would be forced to pay about 40% on the entire million. You'd be paying $400,000 in tax instead of 20% on $100,000. There's a big difference between $20,000 in tax and $400,000. This is going to affect a lot of real estate investors. But there's more to it than just the capital gain tax that is going to be affecting real estate investors. When people pass away and both the husband and the wife finally die, the children have 9 months to file a 706 form for estate tax. We have not had to worry about that for some time. As of the recording of this video, you could leave behind between you and your spouse about $23.5 million before there would be an inheritance tax assessed. And it used to be years ago on any assets over and above $600,000 in the mid-90s. By the turn of the century, in the year 2000, it was $1 million exemption or exclusion. There's still a lot of states that make you pay an inheritance tax on anything you leave behind to your children over and above $1 million. But the federal government had it raised up. Biden now is wanting to raise the tax from about 40% on what you leave your children in an inheritance up to as much as 67%. But he'll probably want to reduce down the threshold back down to $1 million again. So we have a capital gain tax plus an inheritance tax. And so many times children are going to be left with, if they're lucky, 33 cents on the dollar because of those taxes, the capital gain tax or the inheritance tax, when you leave behind assets, especially real estate, to your children if it has appreciated throughout the years. Now, here's one other thing I want you to be thinking about. So you ought to be aware, depending upon the state you live in. For example, California recently passed what is called Proposition 19. I'm not going to go into depth here. I have another YouTube video on that. Proposition 19 replaced Proposition 13, and it affects when you leave real estate behind to your children. Because a lot of times when children would get that or inherit it, they could get that property tax exemption or only have to pay a property tax on the original property tax that was assessed. And now it looks like if you inherit a rental property and if you don't live in it as a personal residence, you are going to have to pay the property tax on the new assessed value. So there's some additional things that are taking place, and there's a lot of states who are thinking of doing a VAT type of a tax on real estate. VAT stands for value added tax. This is where they tax you on the value of an asset as it goes through, let's say, manufacturing process, okay? Well, with real estate, what they're thinking about doing, because they're hard up for tax revenue, California is looking at this. They're thinking, well, why don't we tax people every year on what we think their real estate appreciated by? Maybe it's your home or it's a rental property. If they think it appreciated by 5% and it was worth $1 million, that's 50 grand that it went up in value. They get to determine what it appreciated at, and they want to tax you on the appreciation of your house, not when you finally sell it. They want to do it every year. So they get their money just in case real estate markets plummet and it goes down in value. They want to get their tax when it was up here. This is going to affect a lot of real estate investors. So what should you be doing about this? So if what I've been sharing with you has you concerned, and you can think of somebody who is going to be facing tax issues because of the way they're holding their real estate, be sure and share this video, like, post a comment, but more important than anything, subscribe. But here's what I want to gift you so that you can understand maybe some better ways. A lot of my clients who are real estate investors, this is where they keep their real estate equity. This is where they want to have money where it's liquid, safe, earning predictable rates of return while they own the property. So if the property goes down in value, they don't lose because their real estate equity is not in the property. It's separated from the property. This is what I've always done with my real estate equity. It's called the Laser Fund. And it's actually how to diversify and create the foundation for a tax-free retirement. When you read this book, you'll understand how it's a repository for the money that you would otherwise be tempted to pay in extra principal payments against a mortgage on a rental property. Because here, you'll get out of debt faster, probably 2.5 years faster than giving the money to the mortgage company. So this book, you'll learn how to accumulate your money tax-free, access your money tax-free, and when you ultimately die, it will transfer income tax-free. So this is where a lot of real estate investors actually, when they sell their real estate and say, enough already, they pay the capital gain at today's lower rates rather than waiting for the taxes to go up. And this is where they reposition their money. This is actually 300 pages, but it's 200 pages of right brain charts, graphs, and explanations. You flip the book over and it's 100 pages of 62 stories. And there's a chapter in here dedicated to real estate investing and how the Laser Fund can keep you liquid, safe, earning predictable rates of return. Would you like a free copy? I'll pay for the book. You go to laserfund.com. Again, LASER fund.com. Click below. And you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll fire out a copy for you. There's other options in there to get the audio version, or even an 18-hour deep dive masterclass if you would like. Here's to your brighter future.